Stock seesaw today based on investor sentiment with this trade deal. What's going on? And we're going to talk about the technical ramifications of today in terms of the expectations of this intermediate pullback and whether or not the market will pull back even more going forward, or whether or not, or what the technical signs are suggesting in terms of whether this is the type of intermediate pullback we've seen before and we expect to see now that would lead us to a good bullish bounce going forward. So I'm going to break all that down in today's video, and we're also going to look at a trade idea in a stock where we can get a good bounce opportunity if the market does bounce, and talk about how to manage our risk in case it doesn't. So let's go ahead and get started. Today is Wednesday, May the 8th, 2019. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's take a look at the S&P 500 first and foremost, and we'll see that we traded inside yesterday's range, specifically inside of the lower half of yesterday's range. I've got this I've got this Fibonacci retracement level here. Let me make that stand out a little bit to see if, to let you see it a little bit clearer. So we'll make it blue here. There we go. So that Fibonacci retracement level is the move off of this low point. The last time the intermediate posture was at least weekly bearish, and since that point, you notice we are now we're inside the Fibonacci retracement zone. We're testing the 50% level of that retracement, which again is like, there's a lot. I tweeted this out. Here, give me 1 second. It was right here. I tweeted this out. So like right now, we're down about 2%. We've had this type of decline a couple of times previously. And after both of those, we went up 4% and we went up, whatever that number says up there. Like, we've had pretty decent, and this pullback is only half of that rally so far. So it's like, for all the doom and gloom we got, it's like it's not like we've never seen this before. We just barely saw it and that was a 4-day decline. This has been a 5-day decline. That was a 1-day decline. A couple of days to get to the actual low. So it's like, man, there's a lot of hullabaloo over something that's not necessarily unprecedented. The intermediate posture is weekly bearish again. We've seen that twice during this rally. Now, granted, at some point in time, the intermediate line is going to fall below 50 at some point. And it very well could be this level. In fact, if you notice, the near-term line now has dropped back down below 50 after not peaking above 80 and after only spending 2 days up above the midpoint. So remember, we talked about before that there's two things we're going to look for the near-term line this week. One, for it to peak above 80, and two, for it to stay above 57 at least 7 days. Kind of maybe 5 to 7 because we're so far into this intermediate posture, but a lot more than 2. And so the fact that we didn't get neither is another red flag that we're getting closer to the intermediate line dropping below 50 than we are further away. So we'll see, and you can see the intermediate posture. You can see the 62% Fibonacci retracement lines up with the previous peak, and that peak you see is lined up right here in between. So that's from this low point to that low point. So that peak right there is where the 62% Fibonacci retracement is. And of course, getting below this low point like we did over here, you can see how we were holding that old low point here for a while, and then we just busted through, and that's your bearish sign. And you can see, in fact, we busted through a couple of prior lows that we hit ultimately on the way back up a couple of times before falling down further. So, it's when we get below 2,800, that's your cause of concern. And even then, you still got, another layer of support here right around 2,750. Again, that's, if you look at it here, and that's where your Fibonacci retracement levels are, right? Your 38% right a little bit below 2750, and then your 2800 level right at the 2360. That's 80 points away, and that would be like nothing. That would not be a significant retracement. It would be about 5%, but it wouldn't be like earth-shattering. It wouldn't change the long-term dynamic of the market, which, according to a bunch of seasonality factors, especially this big decline that we had in December, which is by the end of the year will still be pretty bullish, despite any small hiccup Again, if we can't handle hiccups on the markets, if we can't handle higher highs, because everybody can handle those, and higher low points, then we can't handle trends, right? Because that's what the definition of a trend is: higher highs and higher lows, and more than just little wimpy dimpy deaky pullbacks, right? We're talking like exhales, full-on exhales that set us up for new multi-month inhales, right? New multi-month rallies up to new highs again, and we just haven't had that. I haven't had that type of pullback yet. In fact, you can see on the Russell 2000, the intermediate posture is actually still strongly bullish despite the pullback. The near-term line did get above 80 here on this bounce, and a little bit of a kind of a false breakout move here. We got above at the end of last week, got above this 1600 level, and then yesterday got right back down below it. So false breakout move, another red flag that we might be pulling back towards. We might be pulling back now and producing this kind of weaker. Remember, the Russell 2000 already has shown a weak posture, and you notice this pullback that it got barely went past a 23% Fibonacci retracement to bring the intermediate line down. So again, we don't have to fall sharply to get a pullback. We can just fall, because even 23% is not. I mean, the Fibonacci retracement zone is between 38 and 62, and we didn't even come close to touching the top of that zone when we brought the intermediate line down. So now consider that here. We can probably come down into this 2800 area, and that would be enough. Maybe even just this 2850 area. That would be enough to bring the intermediate line down below 50, turn it around again on any subsequent bounce, and then set us up for summer, a move into that July expiration, which typically is a bullish period. A little bit of weakness in June seasonally, but for the most part, heading into July expiration, the markets tend to be pretty positive, right? That's after that July expiration is when seasonally things sour a little bit through August and into September before we get to that October expiration, and we bottom and usually rally into the end of the year. All right, before we look at some other charts, I want to take a little time out and invite you to subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of your screen, and then click that red subscribe button that pops out. That way you're notified when these videos are posted. Also down there, click the thumbs up icon down below the video. That tells me two things. Number one, that you like the video, you got something out of it today. Number two, you want us to do it again tomorrow. So it's a quick way to give us feedback you can do right now while you're watching. Also down there, comment. What did you get out of the video today? Would love to hear. Comment on that down below. Join our daily Market Outlook email list. There's a link popping up there in the top right corner of your screen. It comes with a timestamp summary of these videos, as well as 2 watch lists every day of overbought or oversold clusters from the S&P 500. So subscribe to get those lists. Also, follow me on Twitter for more content in between these videos from day to day. And then finally, join our Market Outlook community that we created on Facebook. Speaking of, follow me on Twitter also. One thing you can get out of it, a little added bonus, is you can get a little piano performance. Sometimes you'll hear my boys practicing their piano upstairs in the background of the videos. We try to keep that to a minimum so I can try to be a little professional here. But my oldest participated in his kind of the state high school piano competition, similar to the state championship, right, in these other sports. And this is the piece that he performed that earned him the highest score there, with all the different classifications all combined into the state competition. So it's like, considering we come from a small central Utah town, it's almost like a Hoosiers, right? Hoosier story, the kid from the small town going up and whomping on the big boys. All right, now let's take a look at the long-term charts for the S&P, and there's your a little bit of a bearish candle closing below the high of the low week, or the low of the high week, right? So we're getting this pullback. We've got another, this is the same. Those other 2% pullbacks that we saw were right here, right, and one previously over here. But you can see where the 2% pullbacks were. That actually culminated right there at that low point. And then so far, this is another one. And so far, it hasn't been anything more than that. But what's different a little bit about this one is compared to these other two. We did get some transition candles on those other 2% pullbacks. And here's another transition candle. This one just happens to be red. And at some point in time, after 17 weeks of bullish candles on Hakuin-Yashi, at some point in time, we'll get at least a few, and even if it's just like this, where you get a few bearish candles that trade around this 50-day moving average before we start a new run. We're going to start a new intermediate rally. Let's take a look at the 3 green arrow charts. We got 3 red arrows today. We got it yesterday, actually, and we're still, that a lot of times 3 red arrows like this one over here will set the low point that we'll bounce off of. You can see it over here too. Obviously, this is when we got the pullback, and that's a possibility. And we saw that once we broke through that old near-term low point, then the floodgates opened up. So we got this. We'll know if something like this happens by watching the chart. But as of right now, it looks very similar to other standpoints. Now, here it didn't last very long. Here is where we spent a few days, about a week, below the moving average. Actually flattened it out and turned it red briefly, whereas here it stayed yellow. So this is probably more the type of pattern that we would need to get the intermediate line down. Finally, if you take a look at the 3 green arrows, you'll see over here, again, the MACD and the stochastics did drop below their midpoints, and we are pretty much there now. They don't have to drop sharply below like we did in these other 2 pullbacks, but unlike here, we didn't drop below the midpoint, at least on the MACD. And you can see the 8 and 17 day both stayed above, whereas during an intermediate pullback, you will get at least briefly the 8 and 17 day trading below the 30. And so we're getting a lot closer to that now, especially with the 8 day almost crossing the 17 day, which is what the MACD down here represents, the blue line crossing below 0. We're a lot closer to that happening than we were either of these 2 times. All right, now let's look at the intraday charts for today, and you see we set a new 4-week low point today. So just like that. Now it's not that big of a range. It's only about 9 points. So 29 points would get to the 10% mark. So it's not like we haven't had a 10% pullback here, but it's a decent range. It's so 13 points would be over 5%. So you see we haven't even had the 5% pullback, and of course we bounced off of that here. And actually in the after hours we were trading a little bit above 288, so a little bit of a bounce even with the pullback here late in the session. If you take a look at today's volume, we've had a couple big jumps in volume, right? So you can see when we have our pullbacks, we have a jump in volume, and that's about it, right? We have a little bit of volume here, sets the low point, and then we bounce off of that. So yesterday we had a big jump in volume. Will that set the low point? You see over here we had surges in volume when we broke down below that. So again, we don't have that here. As of right now, this pullback is still looking more like this one than it is either of these 2. If we take a look at the range, of course, for the S&P today was just a little bit below average. And the volume is at 91.5 million. So when we look at it on this chart, the average range is still low. The volume at 91 million is still relatively low. So they're both above their average. The averages are moving higher, but this hasn't crossed back above 1% yet. And we don't have it's the 4 and 5 point ranges. If we consistently get those with 100, 125 million like we did yesterday. Yesterday we had a 5-point range. We had decent volume up to these levels. Those are bearish days. And the fact that we didn't follow that up with another down day today that was more of a smaller inside day is a relatively positive sign in terms of, not that we won't get any more selling, but in terms of this is going to, potentially could look a lot more like this pullback than this one over here. All right, finally, let's take a look at the volatility index. You can see the VIX is up around 20, especially this little late rally we had at the very, very end of the day. We're up at that 105% level. Just again, to kind of give you some context on that. Here, let's go to a daily chart. And then actually, let me go to a 5-year chart. I thought I hit that the first time. So again, when we surge up above this 115% level, then that's when we'll have more of a pullback, more of a surge back down. We don't have that here. We did get up to 105, and we've seen there's been other times where we get up around 105 and then bounce back, pull back down in volatility. You can see lots of instances, but you can also see where the big surges are. So that surge, at the end of 2015 led to a death cross, a couple of death crosses. Then we had this surge here during the election. that eventually bounced almost immediately back down. And then there's your surge at the beginning of 2018, and then here in October 1st, and then December. So those are more of your big pullbacks. Again, that's not what we're getting here still, as of right now. And you also see, too, that the range for the ATR, the average range for volatility on the monthly basis is 9 points roughly. And as of right now, we are at the range this month is 9 points. And we mentioned at the end of last month in this video that we were setting up the environment at 3.36 points there is setting up an environment for a bounce in volatility, which we got. And you see there's lots of bounces like this in volatility without having the big surges. There's your couple of surges that we had on the volume that we saw previously, as well as on the VIX ratio chart. All the rest of these you can see aren't so big, and then we pull back down. And I'm going to venture to guess if we hold this high point on volatility here like right now, then we'll probably end up starting to move our way back down on this, and as we bounce up higher. Otherwise, we break up through 22, 24, we're probably going to end up getting another one of those surges. I don't expect that to happen. You can kind of see there. See if I can go out a little bit further. There's your surges when they get above 100, up to this 115%. That's where you'll get the big extreme moves in volatility. I don't think this is it. I think it's more of a that we'll peak in this area and then start working our way down towards the bottom of this bearish zone between 95 and 105 before eventually breaking back down as we bounce off a new intermediate low point below 90 into this range and start trading toward like this, between the 90 and 80 levels. So, that's all just conjecture and opinion, but that's my expectations based on how I'm seeing a lot of these technicals here together on the charts. All right, before we look at the drivers of the market here today, what's driving the market and our trade idea, now it's your turn to vote. What do you think about this outlook that we just came up with through our routine? Do you agree with that or disagree? Click that link that's popping out in the top right corner of your screen, opens up the poll, then hit either agree or disagree in that poll. If you click disagree, scroll to the bottom. Let's keep this conversation going. What do you think? What are you seeing that would suggest either that you're more bullish or more bearish on the pullback that I expect? Let me know and share the charts or signs or signals that you're seeing that would disagree with what we're seeing here today with our outlook. All right, now let's take a look at what's driving the price action today, and we'll just take a look. You can just see over here on the right-hand side of the chart. Look how, again, DBA still remains weak, and that's your big signal in terms of like trade deal expectations. The fact that it's still weak shows that we're not out of the woods yet, and that's what caused some of this weakness, especially here at the end. But you also see a nice little rally in crude oil. It's not off of its lows yet. We're not breaking previous high points here. But it stopped going down, and that stopped the bleeding on the markets. So for us to change around in the equities, most likely we're going to have to get a bounce back up in crude oil here up to new highs. You can see safe haven trades are all over the last couple of weeks here with the market only down 2%. Dollar, foreign bonds, gold, long-term treasuries all rallying. They're the only ones that are above. But what it's a good sign here is just over the last couple of days is where we finally got some weakness in small cap stocks. They were actually positive previously, a lot more positive than the large caps, and just now and still are outperforming large caps during this pullback. So that's a decent sign for risk appetite. In fact, that's the only risk-on relationship we have. All the rest of them are more risk-off, but that's to be expected when we are getting a risk-off, a pullback. But it's a good sign for the broad market as a whole that small cap stocks, which have been lagging the last month or so, are finally starting to show some outperformance and rally up against the S&P. Again, that's a good sign for risk appetite, at least among U.S. investors. From a news standpoint, the calendar is very light. In fact, the biggest news that continues to dominate the market and these relationships here is the trade deal expectations and what will happen potentially by the end of this week. You can see obviously impacting because here's where most of that weakness has come from Friday. In fact, if I were to go here and and change this to Monday, and then we'll go 10 minutes. So you can see, obviously, the biggest driver, the biggest market in the emerging markets is China. So China's got the down 4% versus the S&P down just 2.25% since last Friday's close. So it's a pretty significant. You can see treasuries, but you also treasuries up, but you also see crude oil after being pretty bearish itself, rallying and is up. So again, the market's got this on the mind, right? The agricultural commodities are down, but crude oil is up. The dollar is up. Gold is up. Foreign bonds are up. So safety, right? The market's anticipating, or at least prepping for what's going on this week. Of course, the MO for the administration is, generally speaking, when they're negotiating some kind of deal, is for things to be as bad as it can be before. It seems to be a pattern. And whether or not that's the pattern they're following right now, the precedent has been for things to look as bad as they can possibly be before, whether it includes the government shutdown or trade or tax reform, whatever. But the pattern has been to look as bad as it can be before things settle down. And so right now, this is how the markets are reacting to the environment of looking as bad as it can possibly be. And the expectation is, if there's even if there's no deal by the end of the week, but if there's any kind of positive remarks and no tariffs potentially, then the market might still be weak, kind of pricing in that, and we might still get that intermediate pullback, but it won't be the free fall that, again, a lot of people are expecting, assuming a negative outcome from this week's negotiations. When you look at the markets here, you can see, again, China is well below a falling moving average now, and it's got a strong bearish posture. So it's got the bearish combination here that the S&P 500 just doesn't as of right now. And this is the very similar pattern that we saw last year that persisted for most of last year until October, December, where the markets all peaked in January, and then they started to come down, and the S&P bounced into October highs. The China never bounced. It continued down, and most of the foreign markets did. It's nice to see that the European markets are still holding some strength, at least Germany. You can see France and the UK are showing relative weakness, but not very much. It's these Asian emerging markets, whether even developed markets like in Japan, you can see they're the ones that are getting hit the hardest by any kind of negative investor sentiment towards a trade deal impasse between the two largest economies in the world. Now let's focus more on the U.S. markets and take a look at the sector rotation. You can see how the sectors performed here today, and let's take a look at the sector 12 grid over here on the right. You can see healthcare continuing to bounce up a little bit. Remember, it was the weakest one. It was down the most. Some of these others have been more flat. You can see energy relatively flat. Industrials up here at the top, relatively flat. Real estate also over here, relatively flat. And it's got the flat moving average along with utilities. In fact, both of them are below now falling moving averages. So some weakness there. Healthcare also still below falling moving average, as well as energy. Even so, you can see how bullish the market is, and you've got 1, 2, 3, 4 of its sectors trading below falling moving averages, and you've got 1, 2, 3, like the S&P, trading below rising moving averages, and then you have like financials and communication services and staples that are both still trading above their rising moving averages despite the pullback. So you can see the discrepancy here, and that's generally the case when you're at the end of an intermediate run. You start getting some discrepancies, and eventually, the markets will bounce, and they'll all bounce this to one degree or another before they all start to diverge again, depending upon which sectors do well and don't. So again, another one of those signs that this pullback is probably going to be a little bit more meaningful than the last couple that produced just weak intermediate postures. So with that in mind, this three red arrow pattern is so common in terms of like giving us a buy signal, a buying opportunity when you're on a bullish trend. Even if whether it's like this one where we bounced almost immediately, or even if it's like last summer where we finally got that kind of bullish intermediate pullback. where it set the low point and we traded around the low point before bouncing. So whether either case, the 3 red arrow signal typically sets the low point for the broad market and gives us an opportunity for a bounce. So if we take a look at one stock in particular that I wanted to take a look at is Yum Brands, which has also pulled back. You notice it's got a light pink shading, might even pull the intermediate line down below 50. You see short-term sentiment has pulled back down here. Lots of, kind of bearish, a divergent near-term high, now a bearish high point, and a slightly oversold near-term line, similar to what we had over here. And then the near-term momentum lines can be extreme on individual stocks. So I don't put as much stock into it, but a little bit of a red flag there. But we got 3 red arrows here. If you notice, so again, no red line, and no dark pink shading, which is the bearish combination, right? That we don't like to see. So we just see, as of right now, a green line, and maybe it will be yellow tomorrow because we are below the moving average. But that's a bullish combination when we see just a yellow line and light pink shading, at least as of right now. So when you look at the 3 green arrows, you can see the 3 red arrows that occurred today. Usually it's the moving average. The MACD is usually the first red arrow to appear, and the moving average usually is the last one to appear. And then as we bounce, if we bounce, the moving average usually is the first one to appear, and then the MACD is the last one, so it kind of flip-flops. So that's kind of gives us an idea of what we can expect if we get the bounce, how it's going to look, and to know when we won't, if we won't get that bounce on the stock. If we take a look at the long-term chart for Yum Brands, we still have very strong positive momentum. We're still trading around the moving average, around the 50-day moving average. So we haven't broken through there and really started to bounce down. And you can see on this rally, we've tested that 50-day moving average the last time we got the 3 red arrows. So you expect something similar here to the upside. If you take a look at the Bollinger Bands for Yum Brands, we're not threatening the lower band anytime soon, and you see all this volume support that we have in this area, which suggests if we pull back down any more, there might be a little bit more pullback, but you're going to have some relatively strong support. And if it busts through, then it busts through, and we'll talk about how to manage that. But you can kind of see as during this pullback, we're not breaking below the lower band. We're not, we're in the lower half of the chart, but not significantly down there. And you've got some volume support. And if you look at the DMI so far in the pullback, we're not above 25 on the orange line. We're not below 20 yet on the blue line, which is the bearish combination. So, for a 3 red arrow signal and a good volume here, there's an opportunity that we could bounce on this trade. So how do we trade that? Well, you notice I've got a trade pulled up here. We can go 44 days out and buy this at the money option and then sell the 105. So when you look at that on the chart here, it gives us a $300 gain reward if we get back up above 105 and stay there, versus a $200 loss. And you can see the 1 standard deviation move at current volatility levels would set us up for a here, let's just set that slice to break even, would set us up for a move potentially up to 107 or higher. So a move off of a higher low to a new higher high. We've got the volatility suggests we got plenty of time for that move to develop. Even if we hammer around here for a while, right? That still would include that. There's 60, in 1 standard deviation, there's 68 different options, and some of those options include hammering around here before bouncing and eventually closing up above this around that 107 level within 1 standard deviation. So with that being said, you notice here on the pullback it said we're risking $200. The reality is we're not really risking $200 to try to get that 300. Because if you remember on short vertical spreads, it's really easy to get that first 50% of the gain, and then takes a lot longer to get the 0.5%. So you notice that that's kind of different here, where you can get most of your reward before it really starts to slow down. On the other hand, you can see you lose about half of your max loss really quickly. And then after that, so again, if we were to break down into this 97, we will have broken down. Like this 3 red arrow signal is not going to be a bounce. It would be 3% below this $100 low point. We're obviously not bouncing. So instead of taking $200 loss, we're really risking about $100, because after that break point, that midpoint, it takes a lot longer to get the rest of the loss. So I'm really not risking the full $200. I'm risking more around 100. Is a more, if things don't move as we expect and it does break down here, then I'll end up in 97 is way down here, so we'd have to break through that low point. Then I'll end up taking about $100 loss for the potential reward of a $300 reward if we get up and stay above 105. 3-to-1 reward to risk ratio, not too bad for a stock that's on a bullish trend and maybe giving me a buy the dip opportunity here. All right, so now that you've heard from me, now I want to hear from you. Let's keep this conversation going about our market outlook here and the trade idea and what's driving the markets in our Market Outlook forum. So click that link up there. That will take you specifically to the Market Outlook forums on MarketScholars.com. Open up any new thread or reply to anybody else's thread about questions or comments you have on anything in the video today or anything that we didn't cover in the video today. The point is to keep the conversation going with other market scholars that are watching this video. Remember, you have to subscribe to our site to participate there, but you can do that for free with that subscribe box in the upper right corner of the blog post that you might be watching this video from. As always, thank you very much for watching our video today. Remember to subscribe to our YouTube channel, hit that thumbs up icon, and comment on the video. Follow me on Twitter for more content like this in between videos, and join our Market Outlook community we created on Facebook as well as in our forums on MarketScholars.com. Have a great rest of your evening, everybody, and we'll see you all next time.